Welcome to today's What Moved the Market show. I'm your host Prem. It's Tuesday, February 10th, 2026, and here is everything you need to know as the markets close for today. Indian equities extended their winning streak for a third straight session, but with a bit more nuance under the surface than the headline indices suggest. The Nifty 50 finished comfortably above the 25,900 mark, closing around 25,935, up about 68 points, or roughly 0.3%, while the Sensex added around 200 odd points to end near 84,274, a gain of about 0.25%. The Nifty Bank Index though broke step with the frontline benchmarks, slipping around 43 points to close near 60,626, a mild fall of roughly 0.1% after its recent outperformance. So the tone was positive but a little more selective, with broad buying in autos, metals and media, and some profit-taking in rate-sensitives and defensives. Sentiment stayed supported by a mix of strong foreign inflows over the last few sessions, optimism around the recently announced India-US trade framework, stable global markets, and a cooling India VIX, which is now hovering in the low double digits, signaling subdued near-term fear. Zooming into stock-specific action, the leadership baton stayed firmly with a handful of heavyweights and mid-caps. On the Nifty, Eternal, Tata Steel, ONGC, and Bajaj Auto were among the standout gainers. Eternal extended its recent momentum, rallying by the mid-single digits after hitting a fresh intraday high, with strong technical positioning above key moving averages and continued buying interest in the broader e-retail and platform space. Tata Steel built further on its robust December quarter numbers, where profits surged sharply on the back of higher domestic volumes, and on a constructive pricing outlook as both Indian demand and European realizations improve. That optimism kept metal stocks well bid today. ONGC moved higher in tandem with firm crude prices and on expectations of better realizations as the India-US energy axis under the new trade framework deepens. Bajaj Auto also remained in favor after its healthy earnings, resilient export commentary, and continued premiumization in its product mix, which together have kept the stock very much in the market's quality growth at a reasonable price bucket. On the flip side, HCL Technologies, Bajaj Finance, Dr. Reddy's Laboratories, and Shriram Finance were among the notable losers. In IT, HCL Tech saw profit-taking after its recent bounce, as investors rotated selectively within the sector and stayed cautious ahead of incoming global macro data and commentary from US tech peers. Bajaj Finance and Shriram Finance both remained under pressure after earlier earnings showed strong underlying growth, but also highlighted margin and asset quality questions. In Shriram's case, a year-on-year decline in headline profit and the overhang of a large planned capital infusion have kept the trade choppy. From a levels perspective, today was all about the indices respecting well-watched technical zones. Nifty intraday once again probed the 26,000 mark, topping out just shy of it, near 25,989, before sellers emerged, underlining that 26,000 to around 26,300 remains a heavy near-term resistance band flagged by most technical houses. On the downside, the index repeatedly defended support around 25,800 to 25,830, an area that also coincides with key moving averages and with heavy put-open interest in weekly derivatives. Bank Nifty, meanwhile, is consolidating just above the psychologically important 60,000 mark. It tested supply zones around 60,800 earlier in the day, but faded to close near 60,626. For traders, the key supports now lie around 60,500 and then 60,000 even, while resistance is stacked between roughly 60,800 and 61,200, where call writers remain active. Autos added close to 1%, building on strong volume prints and margin resilience in key OEMs, and benefiting from a fall in volatility and benign fuel price expectations. Metals also outperformed, riding on the combination of Tata Steel's strong quarter, an improving global steel demand narrative, and the tailwind from the India-US trade framework, which is expected to aid select exporters. At the other end, pharma and PSU banks lagged. Pharma eased on stock-specific earnings disappointments and lingering US regulatory worries, while PSU banks paused after a sharp run-up, as traders locked in gains and shifted some exposure into private lenders and autos. In the derivatives world, participants are also adjusting to SEBI's recent tweak on calendar spread margin benefits in single-stock derivatives on expiry day, which changes how much margin relief is available when you roll positions. That has encouraged slightly more conservative expiry week positioning in some high beta names and has been a quiet background influence on intraday futures and options flows. Turning to commodities, the mix today was mildly supportive for equities but very positive for precious metals. Brent crude hovered in the high 60s, around $69 a barrel, off its recent peaks, but still reflecting a geopolitical risk premium from ongoing tensions in key producing regions. That level is high enough to keep upstream names like ONGC interested, but not so elevated as to seriously spook India's macro story, and that balance was reflected in the way energy and auto stocks traded. Gold and silver, meanwhile, stayed firmly in rally mode. On the multi-commodity exchange, benchmark gold futures for near-month delivery were trading close to 1,58,000 rupees per 10 grams, as per the latest available ticks, edging back toward the psychologically important 1,60,000 mark after a sharp pullback earlier this month. Silver has been even more dramatic. Spot prices around 3 lakh rupees per kilogram and MCX futures near the 2,85,000 zone mark, a recovery of roughly the mid-single digits in percent terms just over the last couple of sessions. The drivers remain familiar: a softer dollar, expectations of easier global financial conditions later in the year, and safe haven buying on geopolitical and trade uncertainty. But the scale of the move is being watched closely by equity traders, because sustained strength in bullion can divert some domestic savings away from stocks and also feeds into RBI's inflation calculus. Geopolitically, the market narrative is still dominated by the recent India-US tariff and trade framework. By cutting US tariffs sharply on a basket of Indian goods and setting out a clear roadmap for large Indian purchases of US energy, aircraft and technology, the deal has eased a major overhang on exporters and has been a key reason why foreign investors have turned net buyers again over the past several sessions. At the same time, the flip side of trade diplomacy is visible in sectors like textiles, where a separate US move to offer zero tariffs on certain apparel imports from Bangladesh has weighed on select Indian exporters and was one of the talking points behind today's weakness in some textile midcaps. More broadly, investors are tracking developments in the Middle East and in global energy markets, but for now those risks are being reflected more through the crude and bullion screens than through outright panic in equities. Looking ahead to tomorrow's trade, the technical picture is fairly well defined. For Nifty 50, the immediate battlefield remains that 25,800 to 26,000 corridor. As long as the index holds above 25,800 on closing or sustained intraday basis, the bias stays upward, with any decisive breakout above 26,000 likely to open the door first to the 26,200 region and then potentially the upper part of the 26,300 zone over the next few sessions, barring adverse news. On the downside, a clean break below 25,800 would bring supports near 25,650 and then 25,450 into play, and would probably coincide with some unwinding of long positions from short-term traders. Bank Nifty looks set for a more range-bound session unless a fresh catalyst emerges. The key supports to watch are around 60,500 and, more importantly, the 60,000 round figure, where both price action and options positioning indicate strong demand. On the upside, resistance remains in the 60,800 to 61,200 band. Repeated failures in that region could keep banks in a consolidation phase even if Nifty edges higher, while a convincing move through those levels would reignite talk of a fresh leg up in financials. Catalysts to watch include incoming global inflation data, the new domestic CPI series release, crude moves and any follow-up communication on the India-US trade and tariff front. To wrap up with one actionable takeaway, with Nifty parked just below a heavy resistance at 26,000 and Bank Nifty cooling off after a strong run, this is a market that is rewarding selectivity rather than aggression. For the next session, traders may want to align themselves with the day's clear themes by looking for buy-on-dip opportunities in structurally strong leaders from today's outperforming pockets. Autos, quality private banks and top-tier metals, ideally closer to the Nifty support zone around 25,800, while keeping risk tight with clearly defined stop levels just below the 25,650 area. At the same time, it makes sense to be cautious on highly valued lenders and weaker pharma names that underperform today, especially if the rupee stays firm and bond yields remain anchored. That's it from today's What Moved the Market show. If you have questions on specific stocks, sectors or trading strategies, send them in and they might feature on an upcoming episode. Stay tuned for tomorrow morning's wrap and send in your questions.